For those of you that haven't met me, my name is Greg Harris, and I'm one of the senior wealth managers here at Holborn Assets. I've got over 10 years worth of experience in financial services now. A large chunk of that was based out of the UK, but still working with clients on an international basis, and certainly those that were kind of quite transient as well. So, working with vast quantities of information, I tried to get the highest level of qualification that there is in the UK and was successful in that quite a few years ago now, I won't say just to show my age, but also in the UAE now, which is where I'm predominantly based. At the moment, there are only 3 advisors currently with the fellow qualification, which is quite a nice distinction between myself and a few of the others. So tax laws, international tax, a bit of a minefield, and certainly not something I would wish to tackle at this time in the morning on my own. So I'm very, very lucky and fortunate to have Neil along with me today, who let's do a bit of a brief introduction on when he comes onto his part of the webinar. But Neil comes with a CV that I imagine is pretty envious to a lot of people out there. Based in the Isle of Man, head of technical services, MD of the Global Trust as well, and represents IFGL, who we'll kind of delve into a little bit more when we come onto his section. Also represents the sort of RL360 brand, which sits within that group of companies as well. So is probably the best placed person that we could have invited along today to speak to some of the technical areas and most importantly, the solutions or some of the potential solutions that we'll run through. So again, Neil, I know we'll come on to your section a little bit later, but I just wanted to say a warm welcome to you and thank you very much for taking part in today's session.
Thanks, Greg.
So let's have a quick look then at the agenda. I'm sure a lot of you will be kind of keen to hear the solution, but as always, it's really important to understand the landscape that we're in currently. So we're going to start off by taking a bit of a helicopter view of the current position and why this area now has become so vital and so important to those that it affects, which is quite a number of people, even though they might not realize it at this point, and effectively kind of understand some of the jargon that's here. Our industry is one, and Neil will probably attest to this as well, whereby we try and when we're client facing, we have to do our best not to repeat financial jargon by any stretch of the imagination. But every now and then it's quite difficult not to do so. So we'll cover off the definition of what is called non-resident alien status, the implications of that as well, both legal and financial. And then both Neil and I put some case studies and examples together. I'm a firm believer in making sure that people can kind of view and see the real impact rather than just throwing a load of information at them and hoping that some of it lands and sticks. So between myself and Neil, we will hopefully give you some of the most common examples that we have. But I think it's really important to say, and the first apology up front is that I very much doubt that everyone will be in this exact situation. Everyone's situation is different. This is a highly complex, ever-changing area of financial and tax planning. So, take what you will from this. It's very much deemed as guidance at this stage rather than, a sort of full advice, which obviously you would need to go through and deal with separately. This is really designed to educate people and make sure that people are aware of the situation. We'll then come on to a couple of the solutions. I'll touch on a few, and then, like I said, very fortunate to have Neil come in and explain probably one of the most common, but often, and again, Neil, happy for you to comment on this, maybe one of the most overlooked solutions in the marketplace at the moment.
It is. It's amazing how many people really don't realise that they can potentially have a US estate duty liability. It never seems to surprise me when I come across these people.
Yeah, and I think that's partly due to the complexity potentially, but also I think that part of that is, the people like myself who are in this industry have an obligation to educate and help people understand that, obviously with the likes of Neil here to support us. So we'll then come on as a final step of, what actions do people need to take? I want people to leave this webinar, having listened to my monotone voice for 40 odd minutes, to actually have some tangible takeaways. And like I said, that's not going to be here's a one size fits all solution. It's just going to be an idea of, okay, here are the next steps that are sensible to take in order for people to understand. So let's jump into it then. And like I said, we're going to start off with a little bit of background on Why is this so relevant at this point in time? Now, I imagine a lot of us that are on this webinar today have certainly seen, whether it's in the media, whether it's through peers, whether it's through, things you read on social media, there has been a significant change in US stocks, particularly in the technology sector, whereby investors, whether that's through stock options that they may have, or whether it's direct investments, or even investments that are recommended through your current advisor, the US marketplace has seen a really significant increase in its valuations, which is fantastic for those that have been invested. But also that comes with some of these kind of unknown knowns, effectively, whereby people need to kind of understand the implications of having portfolios which may have been larger now than they were historically. So some of these brands are pretty common. Historically they've been abbreviated to FANGs. They're now more often referred to the Magnificent Seven, or Mag 7, which includes the likes of NVIDIA, which is probably one of the most famous now, certainly from a performance in the last couple of years. We've seen significant, not just percentage increases, but multiples of their share price. So as with anything, and again, those of you that have worked with a financial advisor or financial planner before will probably start to chuckle at this. The first risk warning, but there will be a few in this webinar, and I don't make any apologies for that. They need to be taken seriously. But whenever we're referring to past performance, it's really important that we, recognize that the future is very much uncertain. And, there are certain events, shall we say, such as political, economic, whatever they may be. Obviously, the US is very much in the forefront of that at the moment, which can have big impacts on the US marketplaces, both positively but also negatively. So please, we're talking about today single company, potentially single jurisdiction, but also definitely single sort of sector assets here, which we just need to be really aware of has a huge burden of risk associated with them. So look, just to sort of recap, we've seen that actually for a lot of people that have been invested in US equities, in particular, huge returns, which is great. But again, that creates a slight difficulty when we come on to the next section, which is really relating to the non-resident alien position here. So as with any hopefully decent webinar, I think it's important to start off with a definition. And again, Neil, I'm very happy for you to jump in at any stage here. I know you're going to cover some of these sections off later. But effectively, what we're talking about is a non-resident alien, if we look at the IRS's definition, is anyone who is not a US citizen or not a US national. They don't pass the green card test. They don't pass the substantial presence test. That almost certainly will make you a non-resident alien. Okay, and that is the core concept that we need to sort of carry on through. This is not necessarily a webinar that is designed for people that are US residents or US citizens, because there's slightly different rules, which we'll highlight in the next slide, which kind of impacts you slightly differently. As Neil and I will kind of talk through a little bit later on, there are very specific challenges that non-resident aliens face compared to those that are resident or are citizens in the US. So again, we're trying to help distinguish between the two here. Again, Neil, not to sort of put you on the spot, but anything else you'd add just relative to that sort of terminology? I appreciate it's quite a big subject that I've tried to whittle down into 60 seconds.
No, I think with this earlier in the presentation, I think you've covered everything there, and like you say, we'll get into some of the more complex areas of this a bit later on. Perfect,
lovely stuff. And again, it's almost as though I did that deliberately, but whenever there are, it's not just about the non-resident alien definitions, but whenever you're talking about any kind of complex or tax situation, my recommendation is always speak to a tax expert as well, alongside your financial planner and alongside your accountant or whoever you may be working with. We talk about it as a sort of a professional toolkit, and they very much form part of that. So a bit of a plug to the decent tax experts out there. So let's do a quick comparison then. We've broadly defined the non-resident alien position, but let's have a look at how that differs from non-resident aliens to those that might be US citizens or US green card holders. As with any tax, the regime can kind of be put under a bit of a negative spotlight sometimes, which I think is potentially a little bit unfair, certainly in this situation. If we look at US citizens and green card holders, as you can see on screen, typically they get just shy of $13 million per person, which is, not subject to effectively the nil rate band for estate taxes, which is quite generous when you compare it to the likes of the UK, where, only a married couple will only receive sort of $1 million if they own their own property. So, quite a significant sort of increase on those, actually. The second then comparison is then when we compare that to those non-resident aliens. And as we can see on screen, that threshold drops significantly down to just a mere $60,000. Again, I'm not kind of making light of $60,000 here, but when we compare it versus what citizens and green card holders are able to achieve, that's quite a significant reduction. And this highlights one of the main issues, because anything over and above the $60,000 threshold is then almost certainly subject to the US estate taxes, which, for those of you that don't know, is levied at 40%. So again, this webinar is designed to really highlight two things. One, how can we preserve wealth? Wealth should be something that if we have earned it, whether we have built it up, however you have accumulated it, as long as it's obviously legally done, then there should be an entitlement then to pass that on to loved ones or family members or whoever it may be. So if we can create an environment whereby we can legally take us out of the environment whereby we're not having to pay 40% tax, that's a significant reduction we're preventing from our loved ones from having to see. The second, the second reason why I think this is also an important subject, and again, I know this is something that Neil will come on to and myself a little bit later, is that it makes the administration of the estate significantly more straightforward if assets are structured properly. Like I mentioned at the beginning, I've been in this industry now a long time. I've seen the ups, downs of client journeys, and unfortunately, one of the few inevitabilities in life is that people do pass away, and that obviously causes a huge emotional burden on the family that are left to kind of administer things, amongst many others. So for me, the conversation I'm often having with clients is, yes, okay, how do we structure our assets so that when the time does come that we pass away, the family are not picking up a financial mess. They're picking up a financial plan that is reasonably robust, but also fairly straightforward to administer on death as well, because loved ones and family don't really want to be having to go through that turmoil as well once they're trying to go through the grieving process. So I think I've highlighted this hopefully quite clearly. So now let's have a look at then some of the assets, let's say, that are included within this tax. So again, we'll jump back to the IRS. They effectively state that any US estate taxes can be applied to US situated assets, including real estate, things like tangible property, but mainly in the focus of today will be the stock of US corporations. Now, as you can see on screen, those of you might be sitting quite smugly and going, well, actually, my assets are held offshore. Unfortunately, that doesn't necessarily save you from the 40%. The majority of positions are actually in an environment whereby if you hold stock even outside of the US, so for instance, I'm based out here in the UAE, if I own US stocks and I don't structure them correctly, if I was to pass away, those assets would still be subject to the estate tax that is here. And again, we'll come on to the double taxation agreements a little bit later, which is quite, again, a complex area. But again, having your assets offshore does not necessarily negate you from these taxes. Before I jump into case studies, any sort of comments, Neil, that you think will make? I know you're going to cover this a little bit more detail.
No, Greg. I think, like you say, it's a complex area, and a lot of people really have the wrong assumption about this, in that providing that they hold US stocks or US assets on non-US certain types of platforms, or whether it's directly in a different country, that they're outside of the scope of the legislation. But the reality is that they're not, unfortunately.
And again, we'll come on to a bit more of a Q&A, but I know, and again, we don't need to answer it now, but it's just, the size of, if we said, the problem, I think is probably misunderstood by a lot of professionals. You speak to clients, and I also speak to clients on a regular basis. And I think, it seems that the knowledge around this area, it just isn't there, as we've covered off. So again, the whole purpose of today is to hopefully put a bit more of that knowledge out there into the marketplace. So look, let's jump into some examples now then. And again, I know, Neil, you have your own case studies here, but I think certainly from my perspective, the two regular sort of positions that we see clients in, situations that we see clients in, are traditionally one of two. And I've covered both of these off in my case studies. So look, we're looking at case study one, as you can see on screen, an employee that may be working for a large US institution, but the individual may be working abroad. So yeah, again, if I look at and focus on Dubai, where I'm based, we've got a number of huge US companies that are trading over here. And a lot of them for senior employees will offer some form of stock option here. The reason why, for those of you that might not be in that environment, the reason why employers do this very straightforward is effectively it is a massive benefit potentially to an employee. I was speaking to a client a couple of weeks ago, actually, early 30s, worked for a big, I won't name the company, but worked for a huge US company, was provided stock options from pretty much from day one, which is a nice position to be in. They've now got a portfolio of over $900,000 of this company's stock. That far exceeds actually what they've earned over that sort of course of time as well. So effectively doubled their remuneration, which was obviously a very nice thing for them. But then when we started to have the conversations that we're having today, they realized that, as with anything that seems too good to be true, unfortunately, there are some drawbacks that we just need to be aware of. So we've mentioned, and I've mentioned pretty much throughout this webinar that we've got large companies that are offering this. It isn't just the large companies, unfortunately, that are offering these stock options. We're seeing a number of startups now start to take a similar sort of vein and actually attracting people from some of these large businesses to work in these startup environments. And again, huge benefit potentially to the employees that are able to reap the rewards of those. But even within this environment, you're seeing multiples of their share price increase rather than just simple percentages. So stock options, and again, Neil and I have got the task today of trying to cover off very complex areas in a relatively short space of time. So I do apologize if we're going through this quite quickly. But like I said, if you're watching live, it's on demand, so feel free to go back and revisit any of these areas that we cover off quite quickly. But one of the areas I just wanted to cover off, especially with stock options, because it's an important distinguishment, is what's called the vesting schedule. And again, for those people that might not be part of these stock option employers, this might be a completely new term. For those of you that potentially already receive stock options, again, you may be fully aware of this, but it's just important. If you don't know what one applies to you, speak to your HR team, look at the documentation that you've been given, and really understand. Just as a bit of a whistle-stop tour, vesting schedules typically are categorized in three different sections. You have immediate, graded, and cliff vesting. And again, they might form slightly different terminology, but traditionally those are the most common three. Immediate vesting, as the name suggests, that is basically where you get full ownership of those stocks pretty much straight away as soon as the options are granted. So there's no waiting period and you can exercise your options, like I said, pretty much from day one. Naturally, from an employee's perspective, this is the preferred option. You get that immediate benefit. But as we come and have a look at the estate tax perspective, that unfortunately creates an issue pretty much from day one. Because we need to understand that, broadly speaking, if you get stock through stock options, effectively, it's when the shares are vested that potentially the estate taxes then become due. And again, we'll have a look at that and how that looks in the case study in a minute. The next is graded. Graded vesting effectively provides an incremental ownership over time. For instance, you might gain 25% after year one, another 35% after year two, and so on and so forth, until you reach the full 100% ownership. The gradual approach, allows your benefits to accrue naturally, which is a good position to be in. You don't obviously get access to that capital straight away. But also it's a really good way of employers from sort of tying in some of their employees that they're offering these stocks to. Finally, you have cliff vesting. Cliff vesting effectively allows you to gain full ownership after a specific point in time. So again, there might be a time frame attached to the vesting schedule, after which point you would then gain 100% ownership of that stock. after completing a few years worth of service. So again, a good way for employers to be able to tie in their employees that are offering these two. So as I said at the beginning, if you're not sure which one applies to you, my strong suggestion is to speak to your HR before the week is out to understand. So let's rattle through this case study then. So as we can see at the bottom of the screen, let's have a look at the what. So with the vesting schedule information at the back of our minds a little bit as well now, this client has $700,000 of unvested shares, $250,000 are vested, and $600,000 that they've invested themselves into the direct stocks. That doesn't have to be within the same company. So lovely position for the client to be in. They've got a little over $1 million technically in US stocks, although they can't necessarily access all of it. Within this then, let's actually put some sort of flesh to the bones. So of the assets that they have access and control over, they've got current assets of $310,000, made up of the $60,000 single company and the $250,000 that has now vested. If we look at the first 60,000, that's their sort of allowance, that falls into effectively the tax-free allowance section. Lovely. So that then passes on to their loved ones on death. Of the remaining $250,000, only 150,000 then is left after estate taxes are due. Now, obviously, this is after someone has passed away. The remaining 100,000 will then be subject to a 40% estate tax. And again, I'm going to summarize these a little bit here so we can sort of see all the details. But effectively, even if we ignore the unvested shares, which I'll come on to in a second, we're in a position whereby the family are losing out on $100,000 worth of effectively benefits that the employee has already earned, has already accumulated, but because they haven't structured these assets properly, unfortunately, the family is now $100,000 effectively out of pocket. And I would say, and again, I know Neil will cover a little bit of this a little bit later, the IRS are probably one of the most ruthless organizations when it comes to taxes that are owed, whether it's income, capital, or effectively in estate tax or inheritance taxes that are there. They're pretty ruthless, wouldn't you say, Neil?
Yeah, like all tax authorities, they don't like giving anything away.
No, unfortunately not. And it's probably worth saying that all of these sort of structures that we're going to be talking about are legal ways of reducing this tax implication rather than those that are not legal. I'd be a very brave person to come on and try and describe any of that. I think I'd be behind bars pretty quickly. And I like my job and I like my life, so I don't really want to change too much of that. So look, again, a fairly straightforward case study on this one. Hopefully it highlights the kind of the immediate reduction. A secondary point I would make, and again, this is where understanding what vested share position and schedule you have, understand what the unvested shares, will have and what the implications are of your passing if you were to die while those shares have not yet vested. With some companies, they will be returned to the company. With others, you may get a small percentage, and with some more favorable positions, you may still be entitled to them. But again, that all builds into the conversation around estate taxes. Like I said, we'll cover these off in a bit of a summary a bit later. The next case study is, again, a very common one that we get when we get DIY investors effectively looking at those who have invested very aggressively, very heavily into US single company shares and effectively have seen some pretty significant returns on their investments. Again, usual caveat, please don't think that just because investments have performed well in the past few years, they're going to continue exactly the way they have done. I'm not just an advisor trying to cover a certain body part. I am also, very seriously warning people about the risks of single company shares, single jurisdiction, and single industry. So we're going to have a look at this structure. Again, we're only very much focusing on the estate taxes position here. Really important that we understand that there are other taxes that could potentially become payable and due across the course of the lifespan of the individual. So again, always worth speaking to a professional. But effectively, we've got someone here that originally invested around 700,000, let's say. Our current portfolio is now worth 1 million. And the real key distinguishment here is that if an individual has a desire to maintain these assets, irrespective of my recommendations to potentially de-risk or to diversify or whoever they're speaking to, we've got an individual that is keen to maintain their exposure to these assets. There are people like that out there, and the people believe that certain US stocks have still got some mileage in them, which is, if they're right, that's absolutely great. And I'll very much hold up my hands at that point in time and say, yes, you were right. But I think it's really important here to kind of understand that, we've got a maintenance position whereby if people do have the desire to maintain their current structures, they can do so, obviously, as long as they're aware of the risks. So again, we'll have a look at this case study, hopefully in fairly simplistic, illustrative form. We've got a portfolio, as I said, of $1 million. The first 60,000 falls into the tax-free category, and then the remaining $940,000, effectively the net position of that is, I was about to say a mere 564,000, but a significant reduction nonetheless of the total portfolio. And again, if we just follow this through, then the remaining $376,000-ish will form part of the estate tax that needs to be paid. So a near $400,000 reduction in the estate. And again, there are a number of people out there in this situation that are unaware of this. So I want to take this example one step further, or I probably should correct myself, 3 steps further. And again, usual caveat, I'm not saying that these investments are deemed to be guaranteed to increase in value. But if we have a client whereby they do have the desire to maintain this structure of investment portfolios, and they don't restructure the assets in the sense of moving them to an environment that Neil and I will cover off a little bit later, i.e. the solution, I just wanted to show the impact on some sort of potential investment return. So if we look at the next 3 years, and let's say that the client in year one has additional growth of $100,000, year two, 150, and then finally on year three, an additional $250,000 worth of growth on their portfolios, which the client's going to be extremely happy with that. But actually, if we then look at the net position there from an estate tax position, they are losing on that growth alone an additional $200,000 to estate taxes. So again, if we cast the time forward an additional 3 years and assume that these growth rates are correct, they're in a position whereby if the client passes away, they're going to lose just shy of $600,000 in estate taxes alone. Huge reduction. And again, I think one of the other ways to think about this is if that was a portfolio correction, if the funds and the assets corrected by 40%, and you knew about it, you would absolutely do something about that immediately. I would say most investors would. This is a known fact. This is a known entity whereby, the people that we're discussing and we're talking about this with, it's a known entity that unfortunately everyone passes away. And if they pass away with the structure that they effectively continue to have, they will pass away and have that 40% near enough reduction in their estate value to their loved ones. So again, I can't stress the point enough. It's really important to sort of make sure that everything is done correctly. Again, I know you've got your own examples that you're going to go through as well, and I will pass on to you very, very briefly. But again, people take on information in slightly different ways. So for those of you a little bit like myself, whereby illustrations don't necessarily do it for you and blocky data does, then this one's for you. It basically just summarizes the conversations we've had about each of the case studies. What I would say is both of these tables highlight what I've deemed as a reduction in value. And this is a reduction in value on death to your loved ones. So again, if we were looking at this as a portfolio reduction in value, and we knew that it was going to happen, we would almost certainly restructure our portfolio to avoid the assets that are dropping by 32, or in some examples, 38.5%. What I would say is this is a known entity, as I said before. You would need to take action on this if you are desiring to keep these options, or you have US stock options in place. So let's quickly run through them then, as we can see on screen. Case scenario one, we had 310,000 of assets, excluding the unvested shares. We had an estate tax liability of $100,000. Again, simple mathematics. The value that's passed on to the family then is only 210,000 rather than the full 310. That represents a reduction in value to the family, to the loved ones, of 32.26%. Same structure for case study two, same format, should I say. Assets in the current position of $1 million, estate tax liability of 376,000, therefore a reduced value passed on to the family of 624,000, representing a 37.6% loss in value. Year one, That drops again because of the increase. So again, $416,000 worth of estate tax liability. And what we can see through the trend here is that the larger your wealth that is included within these environments, the higher the reduction in value percentage increases, because that $60,000 worth of nil rate band effectively becomes less relevant. So the wealthier you are, I would say, the more important this is to your estate planning. Now, as a final, before we come on to some of the solutions, I thought it was a really interesting way of, a lot of people will have quite clear targets in mind of what they want to pass on to their family as a legacy, whether it's to spouse or children or grandchildren, whatever that may be. And, $1 million for a number of reasons is quite a common structure that we get said, is wanted to be passed on. And I always ask them the question, well, do you know how much you actually need of these US assets to pass on $1 million net? And the figure is actually close to 1.63 million. So you need a portfolio, if you're going to keep things as they are and not restructure them correctly, you need a portfolio of 1.63 million simply to pass on $1 million worth of assets to your loved ones. So again, Neil, I know you've got your own case studies that you're going to kindly talk through in a little bit, and people will be pleased to know that there'll be a change of voice soon. But any sort of comments on this? Is this sort of traditionally what you kind of see quite frequently through your role?
It is, and not to murky the waters, but there are other individuals who, similar to your case study one, who have worked in US corporations overseas for many years, and then left and moved on to do different things, and forgotten all about the stock options that they were gratefully given as part of a fantastic package during their working life, and have absolutely no idea as to what the value of those are, and more importantly, what the liability could be. Yeah.
I couldn't agree more. Nice position to be in when one forgets about those healthy stock options. But you are right. We're talking typically people that get stock options are exceedingly busy, both professionally and personally. I saw it frequently in the UK with again going off on a tangent here slightly, but saw it frequently with pensions as well, or retirement planning. Someone might set something up in their early 30s, let it run its course, or while they're with a certain employer, or in a certain jurisdiction, and then, as you said, complexities of life, people move on, they start up something new, and they end up forgetting about the legacies. The amounts that are, how should we say, put in the comments, forgotten in this industry, or left behind are staggering. So look, let's jump on. I'm conscious of time, but we are good for time at the moment, which is rare whenever I do any public speaking of any description. The solution. So the good news is, for those of you that are in these categories, lots of different ways in which you're able to legally, and I cannot stress enough, legally mitigate the impact of some of these US estate taxes and any other taxes for that matter. Obviously within different jurisdictions, but again, we're focusing very much on the US side here. Some of those can include like restructuring of ownership, corporate accounts, private placement of life assurance, effectively to provide a facility to make the payment to the IRS or whatever governing body the taxes are due. Managed funds is a fantastic way of not only removing yourself out of the environment whereby you might be potentially subject to these taxes, but also that can potentially provide, if you're with a good fund manager, that can potentially provide you with wider diversification as well, which as an advisor or a financial planner, that makes me very happy when people are out of single company shares and not subject to these very, very grave risks. Certain ETFs also based out, and again, it's a bit of a murky area, as kind of Neil was saying with some of the other technical parts. ETFs are a bit murky. In the sense that you've got to be really careful where they're based and also how they're structured and held. So potentially a route out there. Before I hand over to Neil, though, I just wanted to introduce the one of the concepts that I've asked Neil to focus on today, which is the use of effectively a bond structure. And again, the bond structure has got to be very carefully thought out. There are lots of different considerations that individuals need to make. Where are they based jurisdictionally at the moment? Where do they plan on being based? Where are they tax resident? Where are they domiciled? We've got the double taxation agreements as well in place for certain countries, which again provide certain way outs. But as Neil will kind of talk about a little bit later on down the line, not always the kind of the route through. So without further ado, I'm going to hand over to Neil. Again, hugely well regarded in the industry as being the kind of the guru of this. Again, Neil, it sounds like I'm setting up for failure here, isn't it, a little bit, by giving you such a grand introduction. But I think it's important to recognise when someone truly is an expert in their field. And for those of us that are watching potentially on demand, this is the main part. So again, not to take anything away from any of the information we've gone through already, but very, very fortunate to have someone of Neil's caliber on with us today. So again, thank you very much. And I'll hand over. I've now got the duty of clicking through your slides, Neil. So I apologise in advance if I get any of this wrong, but feel free to introduce yourself while I get that all ready.
Thanks, Greg. I think you've given me a more than adequate introduction. Thank you. So we'll kind of just jump onto the slides and run through the one of the solutions that is available to individuals who want to maintain exposure to the US and certain US stocks in particular, but fully realise that there is a US estate duty liability that will have to be settled at some point in time, and want to look at ways of being able to mitigate that.
Yep, perfect.
So as Greg has covered, very well in his example so far, where an individual has got exposure to US stocks or US cited assets, either directly or through a typical type of stock trading platform, then that can result in a US estate duty liability, even though people don't realise that there actually is one, but under the letter of the law, there is. But there are ways in which exposure to US estate duty can be mitigated while still having exposure to the US stocks that individual is particularly fond of buying on a regular basis, if they're a direct investor, or where they have still got some kind of affiliation or loyalty to the business that gratefully gave them those stock options over the years, and they want to maintain them because they can see the kind of the growth numbers that Greg covered in some of his earlier slides. So one of those potential solutions is the use of insurance-based investment products. And these are effectively wrappers, which are very flexible in terms of what they can do in terms of their investment exposure, access requirements, the ability to factor in succession planning strategies, etc. I could go on about these all day, but the focus is really to talk about the estate duty side of things today. So probably the best way to illustrate that is through an example. So we've got Sophia here. She's a non-US person resident in the UAE, is very fortunate enough to have accumulated $1 million worth of US cited assets, so US stock, and is very fond in kind of maintaining exposure to those stocks by using bonuses to top up positions in those types of investments. However, she's aware of the US estate duty position that could bite at some point in time in the future, and therefore is looking for a solution that will be able to alleviate that, because she's done her research. Double taxation agreements, DTAs, we'll come on to shortly, but just to add that they're not all the same, and they're not the silver bullet that everybody thinks they are. So requires some planning, which is going to avoid having to rely on the use of double taxation agreements, and also placing a burden on the her executors, who are the people that have to pick up the pieces to deal with all of this. So what does she do? Well, very straightforward piece of planning here. What she does is she transfers the stock that she owns out of her own name into an insurance-based investment product, so that the insurance company then becomes the legal owner of those assets. And what that means is that even on Sophia's death, there is no exposure to US estate duty. So why is that? It's very straightforward in that assets are transferred out of her name into the name of the insurance company. That means that she is no longer the legal owner of those assets, albeit that she's the beneficiary of the insurance contract and therefore still has some kind of direct exposure to those underlying stocks that she's very, very close to. As the insurance company can't die, Sophia's death does not have any impact on the ownership of those stocks because they're in the ownership of the insurance company. Therefore, Sophia's mortality doesn't trigger an estate duty liability because the insurance company is the legal owner of those stocks at the time of Sophia's death. Another advantage with that type of structure is in respect of succession planning. So after Sophia's death, the insurance-based investment product can be transferred over, so the ownership transferred into the beneficiaries of Sophia's estate, again, with no change in ownership of the underlying assets which are held within that particular product. So it's a really straightforward and easy solution to be able to guide people through, which has additional benefits by not being out of the market. So you're not asking an individual to sell down positions in stock and then have to repurchase them again through the insurance-based investment product because they can just be transferred over with the legal ownership of them changing. Also, all of the administration. So let's say there are US stocks that are held on 10 or 15 different platforms. That's 10 or 15 different platforms that after Sophia passes away, the executives of her estate are going to have to work through, find out where they are, look at what the potential US estate duty position would be on the stocks held in each one of those, and potentially get a clearance certificate from the IRS before those positions can be liquidated and then paid on to the beneficiaries of her estate. So by moving them all into one vehicle, again, it's got the ability there to kind of clean up the whole estate administration and make things a lot simpler. Also, all of our lives tend to be quite complicated these days. Certainly, individuals that have been fortunate enough to work for corporations that would give them, large stock options each year. Those people, in my experience, can typically be quite transient and therefore may not always be in a jurisdiction that has got a favourable double taxation agreement with the US. So that's a very straightforward example in terms of one solution that could be considered in order to mitigate a US estate duty liability while still having a flexible product which can be used for a number of different reasons. But for one particular reason more than others, to mitigate the estate duty position and also make things easier for the next generation or the beneficiaries of the estate who are going to have to come along and have to pick up the pieces and deal with all of this. I think you can jump through the slides, Greg. I think I got carried away talking, and therefore we can probably move on to the final one, I guess, where we talk about the double taxation agreements.
Yeah, here we go. So
the US has entered into a number of double taxation agreements with various countries, which can eliminate US estate duty liability in full or in part. So in one of Greg's very first slides, he said that if you are a US person, then you've got this nearly $30 million exemption, which can be used to set aside any US estate duty liability that would fall through on your death. If you are fortunate enough to be in one of a few countries that has a very comprehensive double taxation agreement with the US, then your estate would be given the same type of allowance. However, it's really important to stress that not all double taxation agreements are the same. Some of them are very different. So in some situations, you may get the full allowance of the nearly $30 million. In others, you may get a much smaller allowance. So, again, it's a case of having to navigate through all of those types of international agreements to see, whether or not you're going to be able to, well, not you, because you won't be around to deal with it, whether your estate is going to be able to leverage the existence of a double taxation agreement and therefore obtain some form of exemption. So I say that they're not all the same. The important point here to stress is that it's for the estate to have to demonstrate to the US the existence of treaty relief under the double taxation agreement. So, your executors have got to pick this up and run with it and be able to demonstrate that some form of relief in full or in part is available against the US estate duty position. It isn't something which is automatically granted. A US platform aren't going to say, well, you're resident in the UK or Ireland, for example, and therefore you've got full treaty relief. The estate has to demonstrate the existence of it in order to potentially obtain a clearance certificate before those benefits can be paid away without any form of US estate tax considerations. So hopefully that's useful. Say it's just one example. These are all things that Greg can go through with you in a significantly more detail than I am at this present moment in time, as and when you engage with him.
No, thank you very much for that, Neil. I think, lots of key areas that you've just highlighted there. And I think, as I kind of said in my section, and again, more open this up to conversation more than anything now, but, I think we as financial planners in particular, and as an industry, we have a real, and it is our jobs to a certain extent, to focus on the financial implications of an individual or a family's sort of financial planning requirements. But I think often, and again, I think a lot of advisors can be often accused of this, rightly or wrongly, but they don't consider the actual practicalities of, not having what effectively is a clean estate, and, things are structured well, things are, not, like you mentioned, scattered across 15 different, DIY platforms or account holdings and things like that. So the burden of requirement, you've mentioned about the burden and emphasis on who needs to action all of these elements is on the estate, the loved ones. These can often be, although you can have an individual that may be very experienced, very financially literate, that has, had the benefit of, let's say, stock options, they might be sophisticated enough to be able to understand the complexities of double taxation agreements. But that doesn't necessarily mean that your loved ones are. Frequently we have an environment whereby there'll be a certain individual within the household that is quite sophisticated, but actually the gap between their knowledge and their family's knowledge is quite severe. Is that something that you see becoming a bit of an issue as well, Neil?
Unfortunately, on a daily basis, it really is. Like you say, you've got the individual who's gone off, taken really good advice, has thought that they've structured things in the right way, and then the next something happens to them, the next generation come along, and they have absolutely no clue in terms of what they need to do to be able to access these types of investments. So, for example, they could all be left under the will of the deceased to the beneficiary, and then the beneficiary will go along and say, "Well, that's great. I've got potentially, let's say it's $2 million. I've inherited $1 million. Has already spent it before they've got it in the bank." And unfortunately, it can take a very, very long time if things aren't structured in a straightforward way in order for the beneficiaries of the estate to be able to access them, and sometimes with significant tax liability. So that 1 million is substantially less by the time that the individual has received it, because things haven't been structured necessarily in the right way.
Yeah, and I think we're both very much singing from the same hymn sheet on that one. One of the other things, Neil, and I've just seen actually that we've had a question come through on this, which is very timely. So I'm going to jump to it if I may. You mentioned about the kind of the legal ownership changing, and again, happy to comment from my perspective. But can you just talk a little bit more, because often when we talk about changes of ownership, people understandably can get a little bit worried that that means that they can't control or access their money. And I know you made the point very clearly about this still provides you with a great level of flexibility. But could you just talk just a little bit about the kind of the difference when we talk about ownership versus control and accessibility in particular?
Yeah, sure. So the various different types of platforms and wrappers that can be used to let's say we're talking about US stock to hold US stock, but the legal structure in which they hold it can be different. So if you've got a, let's say, typical type of investment platforms brokerage account, then the brokerage account will be holding those assets for you on a nominee basis. So ultimately, you legally still own them, and they will just be using their nominee relationship to have custody of those assets and trading them for you. So you've still got a direct link. With other types of product, like in insurance-based investment products, the legal ownership of let's say the stock will change into the legal ownership of the insurance company. However, the individual still has legal ownership of the product which holds the stock, and therefore can still dictate, what happens to the assets that are held within it. It's just a separation of the legal ownership between the insurance product and the actual assets that are held within it. So there is no loss of access, no loss of control. It's just the way things are structured in a different way to have that separation.
Brilliant. Yeah, thank you, Neil. I have nothing to add to that. It's just a very common question we get. Just while we're on the subject, I know we're jumping a little bit forward on this, but only because it's still relevant. One of the other questions we've had through, which I think ties into this a little bit, the sort of flexibility and accessibility piece, is let's say someone does an asset transfer of $1 million, let's say, into this environment. And again, I think either of us can answer this question, but I'll hand it over to you and pose it to you. Can they then change things? So let's say they've got a portfolio which is strictly Magnificent Seven stock, or strictly one single stock from stock options they've received. If they then understand and heed the risk warnings that their advisor is hopefully kind of putting to them, are they then able to change things?
Absolutely, absolutely, and it happens all of the time. So for example, when someone first kind of embarks on the type of planning that we're talking about today, where US estate duty mitigation is their primary focus, then, and they've still, like the stocks that they hold, then that's fine. They're in the product. The estate duty mitigation strategy is working. Things will change as they go through life. They might, fall out of favor with particular stocks, or sort of be looking at exposure, potential bubbles that could happen in the future that we've all seen before in the past, and look to try and minimize that position going forward. So absolutely, the whole investment composition can be changed at any point in time.
Brilliant. Yeah, and I'm not, just to add from my perspective, from a planning side of things, I think people need to be aware that it's not a trading platform, and that also not all providers offer that level of open architecture as how we would kind of traditionally deem it, but they don't offer that level of flexibility. So regardless of who you're working with, and again, obviously I'm here representing, although it's probably inverted on people's screens, Holborn, who've got a huge breadth of product propositions, and work with the likes of Neil and various others, to a great level and a good level of relationship. A word of warning to those that are more the kind of DIY focused or do-it-yourself focused. Not all providers and platforms and products, more importantly, offer this level of flexibility and this structure. So again, a word of warning there. So look, Neil, I think we've actually answered most of the questions that have come through now. So what I'll do is I'll just jump onto kind of the next steps and close this out if that's okay. I will just keep an eye out in case any more questions come through. But hopefully people have found that useful, insightful, relevant, all those things, very much hopefully. What I would say is, if you think that you're sat here listening to what Neil and I have said, and you think that you might be or are already in this situation or close to being into this situation, the earlier you plan, the easier it is to tidy things up and to understand, especially for the stock option position, what you need to do and when. As you can see on screen, I provide free initial consultations to anyone that is interested in finding out a little bit more and wider areas. But my main plug is actually, we haven't charged anyone anything for these webinars. And again, I really do appreciate Neil stepping in and joining us today. But as a bit of a thank you, if you have found this information useful, I'm sure if you're in this situation, then many others within your friends and family and your social network are as well. So please feel free to kind of spread the word. A bit shameless, but a lot of our business is done through referrals, and I think that's a very important thing to continue to do. The last thing I would say is, as you can see on screen, is there's a QR code there. People want to ask any questions off the back of this. That QR code will not expire. So if you're watching this on demand, then by all means you can contact myself there as well and ask any questions you may want to. And lastly, before we close it out, I don't think any more questions have come through, which is great from a timing perspective. We've nearly kept to the time, Neil. But a huge thank you to our guest today, Neil. Again, your knowledge has been hugely insightful. You've also managed to break up the monotonous voice of Greg Harris as well. So thank you very much for that. As always, it's a pleasure to have you on these things and to have you as a point of reference from a technical aspect if we do have any questions. And again, huge thank you to yourself for spending your morning with us this morning.
Thanks, Greg. No problem.
Right. Well, look, thank you everyone for joining. No more questions have come through, so I'll wrap that up there. In the meantime, I hope everyone stays safe and well, and please do feel free to get in touch should anyone need anything. Thank you very much.